It's Veterans Day, and to honor those who've served, we welcome one asset manager to share not only his market perspectives, but lessons learned from his time in the military. I'm absolutely delighted to welcome Ted Oakley, managing partner and founder of Oxbow Advisors, which is based in Austin, Texas, and has over $2.5 billion in assets under management. Ted, thank you for joining us live right now from Austin. Ted, you've seen many cycles, and in your writing, you have said that at the moment, you think the financial markets are currently exhibiting a, quote, madness, an unprecedented level of risk, while the actual US economy is only, quote, so-so. When you think about that balance and this paradox, what do you say to folks trying to figure out how to invest, for example, their retirement savings? Is this the time to put money into the stock market or even to stay invested?
Well, thanks, Ann. I think what happens is, this is an observation, not a prediction, but if you observe that the markets are statistically very expensive, which they are now, we can prove that, and they're as expensive as they've ever been in any period. So if you observe that, then the natural thing to do for someone is to take action to at least settle their portfolio in a little bit to where they have what I call a buffer, or something that gives them some safety going forward, because at some point in time, markets always revert back to the mean, and they will again at some point in time. And we have a tremendous amount of speculation outside of just the market. If you look at crypto and single day options, and there's all sorts of things that are going on, a lot of leverage. But if you can observe that and you say, okay, I know that that's the most it's ever been, then you might want to step back and say, I think I'll take a little bit off the table here.
Okay, so let's say that someone does that and they're holding cash. Talk to us about places where there might be value. Talk to us in particular about commodities. Right? That's somewhere that, unlike crypto and some of the other assets you've just named, commodities have actually underperformed the S&P 500 for quite a long time. Do you think that changes? Is that an opportunity?
I do, Ann. Over the next 10 years, I think you need some commodity exposure, because it's been really 25 years or longer. And if you look at a lot of the commodities today, they're very, very cheap. We happen to think that energy, for example, is the cheapest thing there is right now. But if you look at the amount of dividends they pay, the cash flows they throw, they're down on the lows. But other things as well. You can own fertilizer, you can own iron, you can own copper. There's a lot of things, particularly hard assets and commodities, not as much on soft commodities like, soybeans, cocoa, coffee, that sort of thing. But hard asset commodities, I think you want to own some of those over the next 5 to 10 years.
Ted, let's talk about one particular commodity, which is gold, which has been absolutely skyrocketing this year in particular. What's your perspective on that pricing now over $4,000?
Well, we've owned gold for a long time, actually. We own it, and one of our very, very conservative strategies, we carry about 4 or 5% of it just as a currency hedge. And we've owned it. We weren't late to the party or anything. Our cost basis is low.
Yeah.
But what happens with gold is it goes through cycles like everything else. It's not something necessarily that you can say I'm going to own for 15 or 20 years, because typically those cycles are a little bit shorter. We think we're in a pretty good cycle now. I'm not certain it's over. I know for us, in the last 2 months, we owned the gold miners too, and we sold some of the gold mining companies, at least part of them, I should say. We never sold any of the gold bullion, but it wouldn't surprise us here to have some more weakness in gold. But in the long run, I'm talking about over the next 1 to 2 years, I think it could go to a new high.
Well, in that instance, Ted, if you think it goes to a new high, would you put this in the bucket of folks should be putting their money into gold right now, taking cash off the table and some of the equities and reallocating towards gold?
Okay, if there's two ways. If you don't own any gold at all, Ann, you start small. You don't want to say, okay, I want to own 10% gold. But maybe you buy 1 or 2% gold. You see what happens over this next month or two. If it drifts lower, you push that on up to 3 or 4%. I think 4 or 5% is where you want to be. At least that's where we always get new accounts at some point in time. But we're never big on picking a day and saying this is the day, you know. And so we try to scale into things. But if you don't own any at all, you know, you can start with a little bit. Just give yourself some room so that if it drifts lower, you could add to it if you wanted to.
And what else would you diversify into, Ted, in this kind of market? What are you advising your clients to actually add at this moment in time?
Well, we have two things, Ann. One, in our stock accounts, now we're carrying, even in the stock account, we're carrying about 45% in U.S. Treasury short term. There's not a lot of things to buy, but we own a lot of companies that are outside of the big 10 stocks, even though we own a few of those too. But out of those companies, those other companies, we found some pretty good buys. You know, we own about 40 plus companies, 45 that are in different industries that are still cheap, got a lot of free cash flow, low debt. And then we have another strategy that has the commodities in it. And in those, like I say, the best things we've found are things where they're paying like a high cash flows. I'm talking cash flows that are anywhere between 6 and 10 or 11%. Plus, you've got a lot of upside with the commodity itself. And so there's kind of a mix in there, but there's things to own. On the commodity side, like I say, we own a lot of energy, on fertilizer, on copper, on iron, you know, all those sorts of things. But they all pay a lot of cash flow, those companies do.
And for the non-commodity strategy that you mentioned, Ted, you said 40 or so stocks outside of the big 10. Give us some specific names. What are examples of those?
Well, there's a lot. We own a lot of different industries, you might add, and it's a real spread. But I'll just give you 4 or 5 that we own. For example, we own O'Reilly Automotive. We've owned it for years. It's a great aftermarket automotive stock. It's been a great stock for us, you know, over the years. We own Booking, which is, you know, if you believe that people are going to keep traveling, it's a company. When it gets cheap, that's when we buy them. Then we sell them when they get expensive, and that sort of thing. We just bought Union Pacific, the rail company. You know, we own.
Do you think that deal happens, Ted? Do you think the Union Pacific merger is going to go through?
Well, I think it will. Yeah, I think it will. I think people forget about with pipelines and railroads, you only have so much right of way. If you went in today to try to put a rail line through over half the country, you'd never get it through because you never could get the easement. And so they sort of have a monopoly in their own way from that standpoint. And then we own in the stock accounts, we own a couple of royalty gold companies. That's where you don't own the miner itself, but you get royalties off of other gold miners. And one of those is called Royal Gold. The other one is Wheat Precious Metals. They're Wheaton is good. They're both good companies, but you don't have the risk of having to go in and find the gold in a miner, you know, itself. But then, you know, we own Unilever. You look at almost every product you probably use, as some of them are Unilever. But we have a widespread group, really. Regeneron on the biotech side. These are all things we picked up probably in the last 5-6 months, but all good companies. We try to own a company if we can for 5 to 15 years if we can, as long as we can own them. Some of them we've really never sold, but it just depends on the company.
And you mentioned that you're actually holding quite a lot in short-term treasuries. How are you thinking about holding government debt, Ted, instead of corporate debt? Lots of big companies are out there issuing new debt at the moment. What's your perspective on buying some of that new issuance?
Well, Ann, in one of our high-income portfolios, which is called a high-income portfolio, we bought a number of corporate bonds that were only 5 years in maturity or less. It's only about 3.5 now. But we were trying to get 5 to 5.5% on those corporates at the time. We're not, you know, that's only about 10 or 12% of that portfolio. The reason we keep it in short-term treasuries is because we don't like the long treasury over the long term. Now, in the short run here, maybe it does well, but we feel like over the next 10 years, you do not want to own 20 and 30-year bonds And so we keep it everything less than 18 months. And here's why. If rates went up significantly, then we're going to adjust automatically to it, for that matter. If they go down significantly, we don't think that lasts very long before inflation comes back with a vengeance. And so we want everything mostly to be short term.
So when you think about the rate cuts that we've had so far this year, Ted, and you think about the debate that's raging as to whether there'll be a third cut by the end of this year, what do you think the Fed's going to do?
Well, now I think, Ann, you probably know more about this than I do, but I think they're down to politics now on whether Powell wants to, he knows he's going to go out, and maybe he's like, you know what, I'm not going to give you your way right now. I think we'll hold the line. Maybe that happens, maybe it doesn't, but I don't think it makes any difference. I think they're doing the wrong thing. I mean, you have, if you look at unemployment and you look at the economy, and you look at the deficits, it's just not a time to be aggressively lowering rates. And I feel like this administration will get in trouble there because they're going to push rates down at a time when they shouldn't. What they should be doing is trying to get rid of that deficit, but they're not doing that.
Well, let's talk a little bit about the perspectives of different kinds of investors, Ted. You've said in your work that for those in the age group, say 60 to 80 years old, then exposure to higher stock allocation, there's the risk of drawdown, right? That there's risk there, and thinking about trying to have a safer investment portfolio might be the right way to go. For younger investors, what do you say to them? The old advice would be just sock some money away, put it in the S&P index fund, stick it out, time value, power of compounding. Do you think that conventional wisdom still holds?
Well, I think your question is what to do if you're younger. Am I right on that, Ann?
That's right.
What to do if you're, okay. For a young person, it's different. I mean, you're going to be earning for a long time. So you can put money in the market from time to time. And let's say you get a break back, let's say you have a bad bear market of 50% and you're 28 or 30 years old. That's okay. I mean, you still got a long time to keep adding to that and you'll be all right. What we were saying is if you're 70, you don't have that time because you may not have the time for it to come back. You may get sick. There's all sorts of things that go on. But for young people, they can add to it. I think young people need to have a little cash as well. I mean, it just makes sense to have some. But they're in a different mode. I think they can buy into things, particularly companies, as opposed to indexes. Find a good company, add to it over time. Companies that's where you make the money over time. If you can own a really great company for the next 20 years and you're 28, 30 years old, you're probably going to make a lot of money.
Well, last question for you, Ted. This interview is going to be publishing on Veterans Day. I know that you are a veteran, so thank you for your service. Talk to us about what perhaps your military service gave you in terms of skills for your role in investing. How's that carried forward with you?
Well, I think one of the things it did for me, I'm probably one of the most blessed people you will ever see. I grew up with absolutely zero. I grew up with negative. And so when I went in the Army, it was a way for me to sort of see what was going on. It was during the Vietnam War, but it was a time when I got to see a lot of different people and a lot of different actions and people from all levels, wealthy people, a lot of poor guys, different things. But what it gave me when I got out, I had the GI Bill, so I was able to go on and go to school. But I think what it did for me is it gave me a healthy respect for people of all sorts of people, okay? Because we're, even though we're all a lot alike, we're a little different depending on geographically where we are, kind of how we look at things and that sort of things. But it's probably one of the best things that ever happened to me because I really grew up a lot in the Army.
And how did those lessons serve you as you went into the world of stock picking and investing?
Well, the first place it served me is it helped me get through college because I had the GI Bill. But the other side is I think you have to get when you're really going through tough Army or Marine sort of things, you have to have a grind that makes you realize that, hey, I gotta make this work every day. I gotta make it work this month. And so when you go out in the world, in the section of the world of investing, you have the same thing. In other words, we're a lot like coaching. Like, we had a great year this year, but you know what? It's over December 31, and we're like coaches. What have you done for me lately? So you start all over again January 1, but it makes you realize, hey, you got to keep on pressing, and you'll get there. You don't let up. You always keep your standards high on what you want to own, how you want to do business with people. And I think that's where it gave me the best sort of look at things.
Great wisdom. Ted Oakley, managing partner and founder of Oxbow Advisors. Thank you very much indeed for joining. Appreciate your time.
Hello, everyone. I just want to say, if you like this video and you want to see more of this type of information, because we really try to get the information that you don't see from anybody else, then be sure and click on subscribe, and you'll see more of what we do here at Oxbow.